Today, we're working with just a massive stack of proprietary insight and research. It's all centered on the investment philosophy of one major real estate mogul.
Right.
And our mission is pretty direct. We want to decode his core strategy for building really generational wealth through property.
And we have to talk about the scale here because the source material, it's not theoretical.
No.
This is based on, 30 years in the trenches. Over $1 billion in real estate deals transacted.
$1 billion.
At the time of these sources, his holdings were well over that $1 billion mark. He was controlling almost 5,000 units.
It's just an incredible scope, especially when you think about where he started. I mean, no connections, no inherited wealth, nothing.
Exactly. He modeled his whole approach on historical figures.
We see him bring up Andrew Carnegie all the time, who famously said that 99% of all millionaires have become so through owning real estate.
It's like the foundational truth. But the individual we're studying, he really sharpens that truth into his core philosophy.
Yeah.
He doesn't just want any old piece of land.
Right.
He is very specific. The best investment on earth is earth that produces cash flow.
And that cash flow, that is the non-negotiable part.
It is everything.
Okay, so let's unpack that. Because, he didn't just wake up and buy 5,000 units.
Not at all.
He had to learn some really painful lessons first, starting with the difference between just owning a home and owning an actual asset.
And this origin story is so pivotal because it's basically the anti-model for everything he does now.
Or what not to do.
Exactly. He watched his father, who had 3 homes, buy his final dream property, a waterfront house, almost 2 acres, the whole thing.
This sounds amazing.
It was. But then his father died, and the crucial lesson came right after. His mother had to sell that dream house almost immediately.
Why?
It was just too expensive. Too much work for her to manage alone. It was a liability.
So, lesson 1. The big, beautiful house you live in, the one you're emotionally attached to, it's probably taking money out of your pocket. It's not a financial asset.
Precisely. But even knowing that, intellectually, it didn't save him from making his own mistake.
The classic single-family home mistake.
Yep. At 33, he does what everyone thinks he should do, buys a single-family home, $78,000, puts $5,000 down.
Seems like a pretty responsible first step for an investor. What could go wrong?
Well, at first, nothing. He was getting $140 a month in positive cash flow.
Okay.
And if you do the math, that's a sensational return. It's about a 33.6% return on his down payment.
33%. You'd think you'd hit a home run.
You would. But then the reality of being a small-time landlord hit him. He calls it the dreaded 3 Ts.
Tenants, termites, and toilets.
You got it. That constant drain. He's taking calls from plumbers, from electricians, all while trying to do his main job.
You're just trading your time and your focus, which should be on your career, for this tiny, unreliable trickle of income.
And that's the toxic trade-off. It got really bad when his single tenant moved out in November, right around Christmas.
Of course.
So now he's got 2 months of vacancy, 2 months of negative cash flow, and that completely wiped out all the profit he'd made the entire year.
Wow. The fragility of having just one door, one person leaves, and your whole year's work is just gone.
It was a brutal lesson. He sold that property by March, barely broke even. And he knew, if you factor in his time, he definitely lost money.
That's where the rule comes from.
That's it. His ironclad rule. If it has one door, live in it. Don't invest in it. The risk is just too high. It's a job, not an investment.
That is a profound shift in thinking. So he's done with single-family homes. He spends the next 3 years just studying.
3 years, yeah. Intensely studying deals.
Before he buys his next property. And it's not a duplex. It's not a fourplex.
No.
His first real deal was 48 units.
A massive leap. He realized he couldn't be a landlord anymore. He had to build a business. And that's the whole strategy. Moving to the multifamily commercial model.
So why does the math actually protect you more when you have 48 doors instead of just one?
It's all about risk mitigation. Simple math. You lose one tenant in a single-family home.
You've lost 100% of your income.
100%.
Yeah.
You lose one tenant in a 48-unit complex. You've lost, maybe 2% of your income stream. It's a blip.
All the costs are shared. The roof, the insurance.
Everything is spread across 48 streams of income. It stabilizes the whole operation. It makes the property, as he calls it, bulletproof.
And this brings us to that really crucial distinction between residential and commercial property. A lot of new investors get this wrong.
They do. So anything under 5 units, your house, a duplex, a fourplex, that's usually treated as residential.
Meaning its value is based on comps, right? What the house next door sold for.
Exactly. Comps, curb appeal, emotional stuff. But commercial property, so 5 units and up, their value is based on one thing.
The income.
The income stream. The value is a direct function of the rent you collect.
And the sources are really clear that the real business, it doesn't even start at 5 units. They say 16 units minimum, but preferably 32 or more.
Right.
Why is that number so important?
It all boils down to professional management.
Yeah.
You cannot scale a business if you're the one answering calls about a leaky toilet.
And you can't afford a good manager on a small building.
You just can't. Let's run the numbers on that.
Okay.
Say you have an 8-unit building. Maybe it generates $75,000 a year in gross rent. After taxes, insurance, maintenance, your net operating income, the NOI might be $38,000.
So that's your cash flow before you pay the mortgage.
Correct. Now, a good, competent manager, someone who won't steal from you, they're going to cost you maybe $48,000 a year.
So if your building only brings in $38,000 and the manager costs $48,000, you're instantly losing $10,000 a year.
Instantly. And if you try to pay a manager $15,000, they're not going to care, and they'll probably steal from you anyway. You need a deal that's big enough,
Like 32 or 48 units.
where the NOI can easily cover that manager's salary and still leave a healthy profit for you, the investor. That scale is what lets you be passive.
That's the mindset shift right there. You're not a landlord anymore. You're creating a hands-off business.
Right.
Which brings us to the math, specifically debt and leverage. He calls himself a coward investor. He refuses to speculate. He refuses to lose money.
And that's why apartments are perfect for him. They're real assets. They produce cash flow. They appreciate. But the magic ingredient is that they allow you to use debt.
Leverage.
That is the ultimate multiplier.
Okay, so let's really nail this concept down because this is where the speed of wealth creation really happens.
So you want to buy a $50 million apartment building. The bank is happy to lend you, say, 65 to 75% of that.
So they'll lend you $35 million.
Easily.
Yeah.
Because the asset itself produces the cash flow to pay back the loan.
Right.
So you, the investor, you only have to put down $15 million.
Yeah.
You get all the cash flow and tax benefits on your $15 million, but you own and benefit from the appreciation of the entire $50 million asset.
So how does that change the exit? What does that do for your return?
It's dramatic. If that $50 million property appreciates by just $15 million.
So you sell it for $65 million.
Right. You have just doubled your original cash investment of $15 million. You made $15 million on a $15 million investment.
100% return.
Whereas without leverage, for you to double your money, the property value would have had to jump from $50 million all the way to $100 million. Leverage just turbocharges your return.
Okay, so leverage gets you into the deal.
Yeah.
But it's the cash flow that really determines your timeline. He has this goal of getting to zero cash in.
Yeah, this is the velocity game. It's all about how fast you can get your initial capital back out.
And there's a formula for it.
A very simple one. You take 100 divided by your annual cash flow percentage, and that tells you how many years it takes to get your money back.
So a 10% annual cash flow means you get your capital back in 10 years.
Exactly. But the real goal is to not wait 10 years. The goal is to use that time to force the appreciation.
Forced appreciation, what does that mean?
It means you don't just wait for the market. You actively increase the net operating income.
Yeah.
You raise rents, you cut costs, you add an amenity that people will pay for.
And because commercial real estate is valued based on its income?
The value of the asset immediately goes up. So once it's worth a lot more, you go back to the bank and do a cash-out refinance.
The new, bigger loan pays off the old loan and gives you all your original down payment back?
All of it. And now you own this multi-million-dollar asset with literally zero cash in it.
Yeah.
And you're using the bank's money to fund your next deal.
And this whole system, it's all held up by the bank's willingness to lend. They use something called the debt coverage ratio, the DCR. Why is 1.25 the magic number there?
That 1.25 DCR is the bank's safety net. It's non-negotiable. It just means your net operating income has to be 25% higher than your annual mortgage payment.
So it's a margin of error.
It's a huge margin of error. It tells the bank that even if your taxes go up or you have a few vacancies, the property is still making more than enough money to cover the debt payment with a cushion left over. It makes the asset stable.
That's why apartments get such good debt compared to, say, a speculative land deal.
Absolutely. The bank is lending on the certainty of that income, not just the bricks and mortar.
Okay, so we've hit the SFH mistake, the need for scale, the power of leverage. Let's quickly review the other big mistakes to avoid.
The mistakes are usually about discipline and scale. So number one is buying too small. Anything under 16 units, you're just stuck.
You can't pay for management, you're still a landlord.
You're stuck in that mindset. Mistake number two is using too much debt, over leveraging.
Even though leverage is good?
It's the multiplier, But you never want to use, say, 95% debt. You need to stay in that safe 50 to 75% range. If a deal is financed with huge debt, it usually means it's a riskier, worse deal to begin with.
Okay, now let's talk about the most counterintuitive mistake, which is paying too little for a deal.
Right. Mistake number 3, buying on price, or what's called the cap rate, alone.
So for the listener, the cap rate, that's just the return you'd get if you paid all cash for the property.
Exactly. It's your net operating income divided by the purchase price.
So a building costs $10 million, brings in $500,000 of NOI. That's a 5% cap rate.
Right. And most investors, they chase the highest cap rate. They think a 10% cap is automatically better than a 5% cap.
It sounds better.
It sounds better. But the sources show his best deals, the A-plus properties in growth markets, they almost always come at a premium price and a lower cap rate.
Why?
Because everyone wants them. They're competitive. He says he made his best money by buying high and selling higher. You follow the obvious trends, like tech moving to Austin. If a deal is cheap and easy to get, it's probably not a good deal.
That takes a lot of confidence.
Yep.
And the fourth mistake.
Not using a commercial broker. He says you need to look at 100 deals to buy one. You can't do that on your own. You need those relationships, especially with the listing broker who controls the inventory.
So let's zoom out a bit to the bigger philosophy here. His view on the traditional financial world.
Well, he detests it. Wall Street, 401ks, bonds, he sees it all as pure speculation, a casino game that breaks his number one rule.
Don't lose money.
Don't lose money.
Yeah.
And he believes the system is, well, explicitly stacked against the little guy, the 97% of people who aren't accredited investors.
How so?
He points out this just staggering disparity. For a fund to legally accept money from a non-accredited investor for a big real estate deal, it costs almost $500,000 and takes 6 months of legal work.
$500,000. Okay, what about for a wealthy accredited investor?
$15,000 in 2 weeks.
Wow.
It's designed to keep the 97% out of tangible, cash-flowing assets like a $50 million apartment deal and keep their money in Wall Street's paper products instead.
And that's the whole reason his group, Cardone Capital, was created, to sort of bypass that friction.
Exactly. To give ordinary investors access to those huge institutional-grade deals, the $30 to $200 million properties, that they could never touch on their own.
So what's the big takeaway for you, the listener, from all this? We've seen the failure, the strategy.
I think the ultimate takeaway is that creating real wealth, it requires a vehicle to multiply money, not just to save it. You need an asset class that gives you protection, cash flow, tax benefits, and appreciation all at once.
And you have to shift your thinking from what you can afford to what makes a scalable professional business.
Yes.
And let's end on the potential here, because the math is just so compelling. If you find an asset that gives you, say, a 20% compounded return, what does that actually look like over time?
It's incredible. If you, the listener, you start with just a $10,000 investment, and you add another $10,000 every single year for 20 years, your total cash in is $200,000.
Okay.
But that asset growing at that 20% compounded return would be worth $2.25 million in 20 years.
$2.25 million.
That's the power of the formula. Cash flow times units for scale plus time equals massive appreciation.
And since that appreciation is tied directly to rent, here's the final question for you to think about. Considering everything we know about demographics, inflation, the housing shortage, will rents in major growth cities like Orlando or Houston be higher in 10 or 20 years than they are today?
I mean, it seems like a pretty safe bet.
If the answer is yes, then this asset class, designed specifically to produce cash flow and go up in value when rents rise, might be the single most essential vehicle for your future security.